Prabhat Avasthi, Head of Equity Research and Managing Director with Nomura India Financial Advisories. He joins us live. Prabhat, good morning. Thank you for joining us. Prabhat, I guess the big talking point this Tuesday morning once again is rupee. I guess the regulators are trying to do whatever they can to stem the free fall in rupee. But do you think, given the kind of macros we are working with and the kind of forex reserve RBI is currently, sitting with, the ability of Reserve Bank of India to fight speculators is very limited?
Well, I think RBI, first of all, I think the question is not only of the kind of results. I think RBI is very clear that they do not want to intervene in the market except to check volatility. But I think, Nikunj, one thing that, should be very clear that this move on fundamental side has been led by what happened in the US with QE taper. A lot of emerging market currencies have been hit. And it is very well known that India is a higher beta currency, given the fact that, our current account deficit, our short-term debt, are much higher. So having said that, it's quite possible that rupee might overshoot in a scenario when this macro move is happening. So I would guess that, our view is essentially closer to the fair level. Our currency forecasts actually assume it going to 62 and then coming back to 59 next year. So we're closer to sort of those fair value levels, given the depreciation that has already happened.
Prabhat, what about the market per se? It's gotten hugely volatile in the last couple of trading sessions. Do you think the quantum of the effect of QE tapering news and the currency weakness is all in the price and we're just going to circle around in a 200 odd point band for the Nifty, or do you think things could get worse from here?
Well, I think clearly if the outflows, so first of all, market has been, I guess, in a band for a while now. The volatility of 1 or 2% is part of life, given the fact that global macros are still very uncertain. You got positive news from US, you got negative news from China, then you got this whole monetary easing from US coming to an end. So there are a lot of events which are causing the volatility. I think from India's perspective, the risk case essentially is that if the outflows continue to gain momentum, not only from debt side, which is what been the primary sort of mover on capital outflows, and it sort of shifts to equity, then I think the risks to economy and the markets will increase. I mean, barring that event, I think markets will probably be range bound in the short term, await the currency stability, and then take a cue from there. So I think volatility is something that has been a way of life for the last 2 years, given the global sort of capital flows being volatile on macro news. And that will probably not settle down in the short term or medium term anyways.
If I look at the environment, nothing seems to be going our way, be it rupee, crude, flows, and in general expectations from numbers. But despite a rather gloomy scenario, we are not staring at a selling stampede. 5,500 on the Nifty is still intact. Again and again, Nifty is going to 5,500, 5,600, but there are plenty of takers that. What does that tell you? Does that tell you that market surely is resilient?
Well, I think it tells you that there is a globe out there, and the global conditions in other emerging markets probably are not good as well. They're probably worse in places than compared to India. And remember, Nikunj, India's problems are well known in terms of growth and inflation for a very long time. Current account deficit. At the margin, our inflation has fallen. At the margin, fiscal deficit has come down. What you're essentially seeing right now is a capital outflow on a global event, and that is obviously causing pressures on rupee and on some of the stocks in the market. But on the overall basis, I think relatively speaking, I think there's nothing much which has changed as far as India is concerned with respect to global economies. And in fact, I would argue that some of the news flow from China, for example, has been worse. Because the growth numbers clearly seem to be getting worse there. So I think it's a relative play. In relative context, India is still looking okay from equity investment perspective, and so long as that continues, I think a huge amount of a collapse in the market might not happen. So that is what it's telling, and I think market valuations also matter, because in the end, market valuations are closer to 12.5 times, and within those market valuations, there's a market which is very expensive, the defensive. The rest of the market is extremely cheap. So there will be support also from valuations at the margin, especially the old economy stocks which have beaten down considerably over the last 3 to 4 years. So I think it's a combination of factors.
Prabhat, you just talked about the China slowdown, and that surely is taking its toll on names like Tata Motors. How does one approach the stock now? Is it time to accumulate, or do you think there's further downside in terms of what the slump in China may entail for JLR sales?
Well, I can only talk about a rating, and our rating is a neutral on the stock. Clearly, Chinese situation is going to pressure the margin. China is a very high margin market for all automakers. So the margins in China are much higher than the US. So if US is growing well and China is slowing down, then there will be a margins impact. So our and the domestic business obviously is going to be in trouble for the foreseeable future, given the state of economy, which tends to affect commercial vehicles far more than other auto names. So our rating actually on this stock is a neutral, with clear sort of understanding that there will be some headwinds, which is why it's not a buy for us.
What about IT then, Prabhat, in light of Infi's earnings come Friday? Does it seem like Infi is headed in for a weak quarter? And more importantly, if that be the case, that, most analysts seem to be talking about that Infi perhaps would entail a guidance cut this time, is it all in the price?
So a tech call again, without going to individual stocks and saying what is the price, I would say that our tech ratings, tech sector weight is at this point underweight. We did that about a couple of months back. It's a call which not really worked, primarily because of rupee depreciation, but fundamentally our concern is more on the immigration bill, and we still don't have clarity on that because those motions are still going on. Having said that, I think the important thing in tech is that the current quarter notwithstanding, the US data clearly is improving. So if you look at the long-term relationship of tech sector performance with US data, there is a very, very strong correlation. So I think fundamentally, I think things are improving in tech. The overhang of US immigration bill obviously needs to be clearly out of the way before the tech stocks start to perform meaningfully. As far as Infi is concerned, the only thing I think we need to keep in mind is that there's a change in management, which will involve a change in strategy, which will have its own set of challenges as far as company is concerned in execution, because every time you change course, the companies do tend to, there's unpredictability around how the earnings will look in the near term versus, long term. So I think very hard to say at this point in time how the earnings season for Infi will kick off. But I take your point that there is some apprehension that the quarter might be a bit more slow than was expected earlier.
Prabhat, for those who bought expensive FMCG and expensive consumer names in last 2 years, they have made money. So to your mind, what could be the turning point when one should really, dump FMCG and pharma stocks and revisit growth and, some of the infra names?
So $1 million question. I think it is something that we have been overweight on, pharma and consumer, for a very, very long time. And if you are a fundamental analyst, it will be very hard to justify some of these multiples. So you're right, absolutely, that expensive become more expensive, they continue to perform. And there is no alternative factor which is helping these stocks more than anything else, because the rest of the fundamentals have worsened and worsened, while the delivery of these companies, both in terms of earnings and sales growth, has been extremely stable. So not only has the rest of the market fallen off the cliff, fundamentally, here is a sector where the sales growth and profit growth has held course. So question is, what will give way? So if the economy remains slow, will the sales growth ultimately start slowing down for FMCG? I think that if that was to start to happen, then obviously these stocks can fall because the multiples cannot take an earnings shock. And the second possibility is that the economy starts to recover, where we actually we don't think economic recovery can be effected in a very short time. It needs far more concerted effort, at the margin. So our view is that it will take time for the economic recovery to take hold. So I would guess that there is some risk of earnings disappointment, especially with respect to urban consumer stocks. That is, stocks which are exposed to urban consumer more than rural consumer, primarily because you've seen diesel price hikes, petrol price hikes, electricity price hikes, railway passengers. At a level, consumer pockets are getting pinched, and I think stocks which are urban consumer centric are going to see a slowdown. You're seeing that in autos. You're probably going to see in some of the consumer stocks as well. So it's probably better to be in rural and also in non-discretionary like ITC. Cigarette volumes generally are more immune to economic cycles. So it's better to be in safe names than in names where you could potentially see a slowdown.
Prabhat, so at a time when you expect that the rate of change will not be all that positive, is it time now to avoid a economy-related or economy-linked sector like financials, because that is the core of the market, and if the economy does not recover, banks are unlikely to recover?
So there are two things, Nikunj, so far as banks is concerned. Banks are obviously, you say the growth in banks top lines, that is the loan growth, obviously is linked to economy. Having said that, I think the important thing is that banks, the question to answer is that is the economy seeing the worst in some sense, because the growth picture has been getting worse for the last 2-3 years. It was a while for the market. It took a while for the market participants to figure that out. But I think there is fairly very much in the price in terms of both forecasts of economists or people understanding of what is happening to NPL situation, etc. So my guess is that part of that is in the price. If you look at PSU bank stocks, they're trading at much below price to book they used to trade at 2 times and even more, and they sort of completely gotten beaten down. So I don't think we are going to add any value in saying that you got another 10% downside, because the fact is that a lot of downside has already happened. What happens going forward? I think if the inflation picture and current account picture starts to improve, and maybe we have seen the worst of that, and if there's some stability in macro, then I think there's a possibility that these stocks start to do better. By the way, I think if you take out PSU banks, the rest of the bank pack actually, which is a large part of Bank Nifty, is very defensive in nature. HDFC and HDFC Bank for matter, and they have very large weights in Bank Nifty. So I think the question is, most of the investors are positioned in private banks. The question is, what do you do at the margin? Because people don't have these PSU banks. Do you buy them because the economy at the margin is starting to heal, or do you sort of wait for it to completely bottom out and wait for the last 10% or 20%? That's the question. I think at the margin, banks probably look more interesting, because if people do start getting more bullish in the economy, then the first place you'll go is banks. You'll not go to capital goods first. You'll probably go to banks first, because that's the first expression of bullishness as far as macro is concerned.
Prabhat, what about oil marketing companies? Because they tend to be negatively impacted by the currency weakness.
Absolutely. So that is a straightforward equation. The question is that, again, is the government serious enough in cutting down subsidies as they've been doing, and if they continue to increase diesel prices? And the task has become more difficult because elections are closer and rupee is depreciated, and the subsidy levels have obviously gone up. So the markets believe that the government will clean out the diesel subsidy, probably has gotten dented, and given the fact that the number is closer to 8 rupees now compared to 3-4 rupees that on diesel that was existing before the rupee depreciated. But I think if the government stays the course on the diesel price hikes and continue to sort of push down petroleum subsidy, then I think the confidence of investors will come back.
Prabhat, really good chatting with you.